The biggest tax mistakes that retirees make. We've seen a lot of that over the years.
Yeah, we've had a lot of experience with that. So.
Yeah, a lot of things that retirees can control in retirement based off taxes, and that's the first one.
Yeah, so taking withdrawals without a tax strategy can be very painful at times if you do it at the wrong time. Possibly take distributions out of retirement accounts too early or at the wrong time can be costly.
That's exactly right. So depending on when you retire, there could be potentially penalties. Right. If you retire before 59 and a half, depending on if you roll that money to an IRA or it comes out of a company-sponsored retirement account. So having a tax strategy is one of the first big mistakes if you don't have one.
Mm-hmm. Yep. Ignoring tax brackets in retirement.
Holy moly. Yeah, boy. How many times have we heard retirees say, the first thing I'm going to do in retirement is pay my house off. I'm going to cash in my 401k, maybe IRA or other retirement funds and pay that house off. Mm-hmm. And then all of a sudden they get popped up into maybe 1, 2, or 3 brackets higher.
Right, and if it's at the inappropriate time of, say, you've started Medicare at that point.
Oh, man.
That's where we've, unfortunately, when folks have not sought our advice on paying that house off and done those big distributions, that's where it can be pretty painful.
Well, there's a lot of other ramifications besides just the tax bill when that shows up. And if you're cashing out, for an example, out of a 401k, well, the 401k company is only going to withhold 20%.
Right. It may not be enough.
And you may end up in the top 37% bracket for Fed. So you may have thought you had prepaid your taxes. Come to find out at tax filing, oh no, old Uncle Sam wants more money.
Yeah, and we've seen it time and time again where we've got retirees that's all they've done is saved in their 401k plan, and if that's the only asset you've got you'll have that kind of waterfall effect where distributions to pay your taxes from last year will become a problem for
the second year.
Exactly, in years following. So.
Well, and that brings up the third item that we're going to talk about is the taxation of Social Security. So depending on where your income falls, some or a significant portion of your Social Security will be taxable. So there's a way to plan to minimize that. And again, if you don't have a plan, you may end up having 85% of your Social Security taxed.
Right. Yeah, a lot of people don't plan for that.
No. Now, with the big, beautiful bill that was passed in 2025, there is a little bit of relief, but still, you potentially going to pay some tax.
Right. How about the next one, missing Roth conversion opportunities?
Yeah, exactly. So without understanding what that even means and seeing the opportunities to convert from your IRA to a Roth is a fantastic planning tool.
Right. Yeah. Good planning tool. You know, one thing that we will touch on here momentarily is required minimum distributions. You get later on in years, there are requirements that you have to take out of your retirement accounts, numbers that you have to take out of your retirement accounts. And those can be very, very large, and they can catch you by surprise as well. And so planning around those Roth conversions, maybe pulling some money out of those pre-tax accounts, converting them, moving them into Roth accounts, and trying to lower that RMD. I call it a bill. At some point in the future is certainly something that is beneficial.
Exactly. So in your mid-60s, there's opportunities to do some planning because, being a great saver, that hopefully you are, and you've saved all this money and it's grown and you don't need it to live on.
Right.
And so then all of a sudden, this year in 2026, it would be when you turn 73, all of a sudden the government says, hey, you're required to take out that required minimum distribution, which had you not been planning ahead could be a significant 5 or 6 digit amount, maybe even 7,
right?
Depending on how good a saver you were. So not only is that going to make your Social Security going to be taxable, maybe push you into a higher tax bracket, it's going to make your Medicare more expensive.
Mm-hmm.
They're just all, as you were saying earlier, the waterfall effect of being a great saver. Well, now all of a sudden, you're every turn there's an additional tax.
Yeah. And a lot of folks don't. You save $2 million in your 401k, let's say, for example, or your IRA. That first year when you turn 70, it could be, somewhere, I'll use round numbers, $80,000 distribution you need to do. And a lot of folks are not planning for an $80,000 distribution out of their retirement account.
No.
So,
Like, hey, that's great.
mm-hmm.
Well, it is great, but there's going to be higher taxes. There's going to be higher Medicare. There's going to be tax on Social Security, all these other things.
Right. So let's just elaborate a little bit more. RMD surprises and penalties. I think we covered the surprise part.
Yeah.
About the penalty side of things.
So let's say you didn't know that you were required to take money out, and so you didn't.
Mm-hmm. Whoops, indeed. It can be costly.
Significant. Used to be a 50% penalty on the amount that you didn't withdraw. Now that penalty has been reduced, and maybe the softer, kinder, gentler IRS maybe even forgives that penalty if you write a sob story letter, send that off along with a special form to the IRS. But still, they don't have to waive the penalty.
Right.
And so, goes back to planning that and understanding the rules, that if you don't do that, it's a big mistake. Big mistake.
Mm-hmm. Next on the list, we do have a program that we run around here, Holistic Plan. So not coordinating investments with taxes. I guess we can elaborate maybe a little bit on the program.
Well, yep. So if you're a saver and you have some maybe after-tax accounts, whether they be at the bank, whether they're invested, they're going to generate 1099s. And so then coordinating what type of tax bill you might have from those after-tax, along with your RMDs, pensions, maybe some part-time income. By taking a look at using some software that we use here called Holistic Plan, can then take a look and say, well, hey, have you thought about doing a Roth conversion? Have you thought about doing this? Have you thought about doing that? Are you taking advantage of the tax code? It's a pretty simple tax code.
Yeah, it's very simple. Yeah, doesn't trip anybody up.
No, easy to understand. This software takes into account all the changes that happen every year, and then gives us the good feedback to say, hey, well, here's a planning opportunity.
Right, and it does kick out a lot of different things, a lot of different opportunities, different ways to look at things, and there's many ways to, as they say, do things. So
exactly. So really, those were the big mistakes that we wanted to talk about. As a retiree, you do have a lot of control over your future and your future tax hits, as well as other opportunities. So make sure you take advantage of those. Thanks for watching.